Okay, so we are going to do a quick review on how T accounts work in accounting. We start with our basic accounting equation, assets equals liabilities plus owner's equity. Assets are things like cash, supplies, accounts receivable, and equipment. So anything that would qualify as an asset will function in the same manner in a T account. Liabilities and owner's equity are on the right. We are going to use where these accounts are located in the accounting equation to help us remember how T accounts work. The first rule we need to know, though, is debits are always on the left side of the T account, credits are always on the right side. So, debits are on the left, credits are on the right for each account type. It doesn't matter if it's an asset, a liability, or an account in owner's equity. Debit always is on the left, credit is always on the right. Okay. So once we have that down, the next thing we have to know is which side is the increase side for the account and which side is the decrease side for the account. So assets are on the left-hand side of the equation, as we said earlier. So the increase side is always the same side as whatever side that account is on the accounting equation. So a debit will increase assets. Therefore, a credit decreases assets. If I move to the other side of the equation, liabilities are on the right. We increase liabilities with a credit. We decrease with a debit. Capital, increase with a credit, decrease with a debit. Now we're going to worry about these three that feed into capital later. Just want to go over the fact that we increase on the left or increase on the right according to which side of the accounting equation the account is on. Now the third rule is the normal balance side of any T account is always the same side as the increase side. So if you can get your increase side correct, you're going to get your normal balance side correct. So I'm just going to abbreviate normal balance as NB. So normal balance for assets will be a debit. Normal balance for liabilities will be a credit. And normal balance for capital will be a credit. So that's the basics. Now, we have these accounts that we originally learned were a part of equity. And they are a part of equity, but we're going to find that they feed into our capital account. So for my classes, I teach the happy face, sad face method to help you remember how they function. Capital represents the residual that the owner has in the business after contributions have been made, after profits have been taken into account, and any personal things that have been withdrawn from the business. So, revenues obviously are good for the business. They make capital happy. They operate like capital. They are increased with a credit, decreased with a debit, and the normal balance side is always the credit side. Expenses, however, are going to reduce owner's equity, and they will reduce capital as they feed in later. So they are contrary to capital. They operate in the opposite way. We increase with a debit, we decrease with a credit. Normal balance is on the debit side. Drawing also operates contrary to capital. Increase with a debit, decrease with a credit, and the normal balance side is the debit side.